Hello everyone, we'll talk about real estate syndications, a passive income approach for busy professionals. I'm Aditya Yenumalapalli from Vedam Capital. Thanks for joining me. First, we'll talk about disclaimer. All the information that we share in this is purely for informational purposes. I am not a legal expert this is not legal advice or tax advice or any investment advice. All of this is purely knowledge sharing and trying to educate all the listeners here. So I request you to please consult your advisors before making any investment decisions or making any choices. Let's get into it. Now we'll talk about what syndications are. We'll explain what a real estate syndication is. Briefly cover the details and items that we need to consider in the real estate syndication. We'll talk about how the syndication works, also go over a little typical syndication structure, how the entities are structured, and various other details. And finally, we'll conclude with what Vedam Capital does, who we are, and if there are any questions, and how to continue the discussion further. What is syndication? Real estate syndication is where multiple investors pool their resources, be it capital, time, other expertise, and things like that, to execute a deal which they could individually not be able to afford or manage. This is basically a lot of words to say, hey, a lot of people are pooling money and trying to buy an asset that individually they won't have the money or the expertise or connections or whatever to execute and manage. That's what syndication basically means, right? There are multiple ways to invest in commercial real estate. We'll talk about four ways here, and then we'll talk about the key players in any syndication as well. These syndications can apply to multiple asset classes within the commercial real estate space, be it multifamily assets, be it office space buildings, mobile home parks, self-storage, land development, anything can follow these structures, right? There are, as we talked about and as the screen shows, there are multiple ways you can invest in commercial real estate. One way is if you have the money, you can go buy as an individual investor, or you can have joint venture partnerships where you pool three or four or many different members and groups come together and form a joint venture and execute that, or get into a syndication. So if you are an individual investor and you want to buy a large commercial real estate asset, the capital needs are going to be high. And because you are the sole owner of it, you will have a lot of active participation in executing the deal, managing the deal, and all aspects of the deal. And because you are the sole owner, you have full control of what and how the deal gets executed. You assume all the risk, you assume all the rewards, and all of that. That's what an individual, it's for all practical purposes, is like owning a single family home where you are the sole owner for everything. A slightly modified flavor of that is joint ventures, where let's say if me and few of other friends or family members get together and form an entity, and then say, hey, three or four or five or six people form an entity and say, within this joint venture, let's go buy an asset. That is also possible. In this scenario, the capital investment is not going to be as high as if you are buying it by yourself, but there is a medium-sized capital investment. You will still have equal and active participation because all the joint venture partners, depending on how the joint venture is structured, will have roles defined and where they execute. And the control is going to be shared amongst all of the joint venture partners. A slightly modified version of this joint venture partnership is what we would call a syndication, where, as we said, multiple people pool in, form an entity and execute the deal. And as the right side of the screen shows, there are two key types of players within a real estate syndication. One of them, the first one, are called real estate, the actual syndicators. They're also commonly referred to as general partners or sponsors of the deal, or GPs in simplistic terms, right? They are the ones who will find the deal or an opportunity. They are the ones who underwrite the deal, structure the deal properly, build a business plan and build a team of competent people who can execute or help execute the business plan. They arrange for the financing. They are the ones who assume or sign on the loan and assume the financial risk of it. For most commercial real estate assets, the loans are going to be typically non-recourse. That means the asset itself backs the loan amount, and there are no repercussions to the credit of all the people that are acting as sponsors. There are other bad boy carve-outs and things like that that we'll get into a lot more detail in the later sections or later videos. And these syndicators are also the asset managers. They make all the decisions in terms of what needs to be done, when all aspects of the deal, from buying the deal, the business plan, when what gets executed, managing the property managers, various other team members, and finally taking decisions about capital events, be it refinance or disposition of the asset. All of that is what is the role of a syndicator or a general partner. And passive investors are other key players. They are also most of the times referred to as limited partners or LPs. They are the ones who bring equity into the deal. They invest their capital and their role is going to be limited, and their risk is also limited to the amount of capital they invest into it. They are not signing on the loan or doing any of those aspects, so they don't assume the risk of the deal. They have very limited participation. They are truly passive in nature for the most part, where they write checks, they do sign some paperwork in the initial stages of the syndication, and once the deal is structured, they just get the updates and work with the sponsors and see the money coming in. That's why the role is truly passive, and their responsibilities and the risk are also very limited in this. That's why they are referred to as limited partners. What one of the key expectations or one of the key things that passive investors or limited partners are expected to do is both evaluate the sponsorship team as well as the deal. Because when you are investing in a real estate syndication as a limited partner, this is as much a bet on the horse as it is on a jockey, right? So both of them need to be evaluated. I mean, so that's the key expectation from a passive investor or limited partner. So in this scenario, as the slide says, the capital investment from an individual LP or a general partner is minimal compared to investment from an individual owner or a joint venture kind of a deal. But for limited partners, as we said, they're truly passive and have limited control, whereas for the syndicated general partners, they have more asset management and investor management responsibilities and actual day-to-day operational responsibility of the deal, and they have all the decision making. Now let's talk about a few things that we need to consider, right? I mean, there are various other aspects also. I'm just trying to highlight a few important points that are relevant, and there is a lot more to be learned, and this is a very abridged version of it. First, let's talk about the rules, right? I mean, this is going to be a private placement. I mean, this is where securities are being sold privately. They are not listed public securities, right? So there are rules that govern these kind of structures, and SEC has oversight over these kind of syndications and the entity structures and how the sales of the securities are going to happen. So there are two classes of rules, or two critical rules between the regulation D. They are 506B and 506C that govern these private placement investment offerings. In both of them, I mean, key items that we need to know are there are accredited investors and sophisticated investors, right? I mean, SEC defines an accredited investor as one who is making $200,000 in annual income as a single member, or $300,000 in annual income combined between the member and his or her spouse, or the investor who has $1 million or more of net worth excluding the primary residence, right? I mean, otherwise most folks who live in California or New York and these expensive places, their residences, even a small 3-bedroom home, might be $1.52 million. So they would, that's why primary residence is excluded from the accredited investor statuses. if the sophisticated investors, they might not meet all the criteria that we talked about as an accredited investor, but they are knowledgeable investors who have had experience in dealing with financial instruments and financial investments. So that is another class called sophisticated investors. I'm not calling them out here explicitly because anybody who is looking at investing money in private placements more or less is considered sophisticated. I mean, that's the nature of the beast. But in any case, I mean, for 506B, what it says is in this rule, in this kind of an offering, accredited investors and sophisticated investors, both types of investors are allowed to participate. There is a stipulation where a particular offering of this type can only have a maximum of 35 sophisticated investors participating in it. And they need to have, every investor investing in this kind of a structure, this kind of an offering, needs to have a substantiative and a pre-existing relationship with one or more of the sponsors of this deal of investment offering. Right? That's a very critical component. And advertising of these kind of offerings is not allowed. Whereas for 506C, SEC allows advertising, but the stipulation is it can be offered only to accredited investors. For 506B kind of offerings, when investors are participating, the certification, if I am trying to participate in a 506B offering as an LP, then if I say I'm an accredited investor, there is an investor questionnaire that the sponsorship team would provide me, and I would certify. That certification is self-certification. Whereas in a 506C, I am expected to provide a certification from a third-party provider, be it a CPA, or there are other website services that offer these kind of service where they do, based on all the other relevant documentation and my network, they certify. So in 506C, the certification is mandatory to be had from a third party, whereas in a 506B, self-certification, be it an accredited or a sophisticated investor, is all that is needed. In either case, right, I mean, there is an investor questionnaire that gets provided, and you have to furnish your details, and in a 506B, that would suffice. In a 506C, they would request you to have a third-party certification. Those are the key rules that govern this. This is SEC's way of protecting individual investors, or because these are all private investments and private securities that are getting placed. There is a lot of things that could go wrong, and there are a lot of risks involved. That's why SEC wants to ensure that people that are willing to participate in this understand all the risks and are aware of all the risks that they are taking on themselves by participating in this. That's one thing. And on the right, you see a typical paperwork that is needed or that is entailed in this kind of an offering. As we said multiple times, this is a private offering, right? So all the relevant details of this offering are governed by something called a private placement memorandum. That's a legal document. It talks about all the details of the deal along with the sponsorship, bios of the sponsors, what their track records are, what their business plan has been, and all the other relevant details for this business plan, right? That's what a private placement memorandum is, PPM is provided, and then you'll have a company agreement. We'll talk about how this syndication is going to be structured. That's why this company agreement is going to be a document that has the rules and that governs how the entity is going to be operated and managed and structured, right? And we talked about investor questionnaire a few minutes ago. That's one thing. And then finally, the subscription documents, right? I mean, this document is another legal document that talks about your social security number, all other relevant details, and also talks about the number of units that you're purchasing and all the other aspects of the subscription that are involved in this. And one other key item that I forgot to mention, typically in these kind of placements, you could come in with your cash investments, or you could invest using your IRA, solo 401ks, and some other qualified retirement plans as well. So typically when you are willing to participate in an offering, a sponsorship group, if you have questions, you reach out to them. They'll be able to share more details about what's required and what kind of documentation is needed for each of these kind of entities, right? I mean, other thing is you can participate as an individual member, you can participate as a joint membership, or you can go in and subscribe to this offering as an entity as well. So various ways of participating. And one key item that I want you all to remember is, I mean, there is something called a promote, which is very similar to a carried interest in the fund parlance, right? When you talk about funds and fund managers, you can see these syndicators or sponsors as very similar to a fund manager in an ETF or any funds, right? So they would have something called a carried interest. This real estate or syndicator promote is very similar to that, right? I mean, this is an ownership interest and or a profit interest in the profits of the deal allocated to the sponsors for all the contributions that they and for basically finding and executing the deal, right? So there are many ways that these promotes are structured. There are I've seen straight splits, there are some waterfall structures, and there are a lot of creative ways, and they could vary from deal to deal. So we'll look at a typical deal in one of the next slides. So these are the key things to consider when you're thinking about a real estate syndication. Now let's talk about how the actual syndication works, right? I mean, I mean, this is a busy slide, but it's a fairly simple process once you get a hang of it. So please bear with me and please stay with me. The first thing is that here I'm going to talk about me as a syndicator and me as a sponsor and you as coming in to participate as an LP, right? I mean, so the first thing that we do is we'll have a conversation, we'll start to have establishing a relationship where we'll try to understand your goals, your investment criteria, and we'll talk about what our track record as a sponsor has been, what are our target markets, what is basically our investment philosophy, what we look for, what we try to achieve, and how our key components of the business plan look like. I mean, agreed, every deal, every opportunity has going to be some nuances and differences from business plan perspective, but in general, what we look for, how we want to operate, all of those are being discussed. And then finally, we'll have established a relationship where we as sponsors understand what your goals are, and you as a limited partner and a passive investor understand our investment philosophy, where, what, and how we try to operate, and we'll talk about what our track records are, right? I mean, in my previous experiences as limited partners, when I try to invest as limited partners, I've had conversations, we understand, and there are references that can be provided as well. And I've always gone and invested as an LP in other sponsors deals only based on me getting somebody's referral to asking for an investment, right? I mean, if I haven't gotten any referral for one of the sponsors from one of my family or network or friends or whatever, I haven't invested in any of them, right? So that's purely my philosophy because I'm a very risk averse person. I want to understand. Referrals are the best way of somebody's rating systems, right? So that's why I tend to choose and trust based on someone else who is referring me. So I'm sure most of you guys and most of the people that I've come across are of the same way. So at the end of it, I mean, this is all our hard-earned money, and we are all working for the same thing and willing to working to grow our wealth, right? So it's very important for us to know that our money that we are investing is in safe hands. That's why establishing these criteria, understanding the goals, and having a trusted relationship is very critical. And once that is established, then we get to work as sponsorship team. We evaluate lots of opportunities. We work with brokers within the target markets and target opportunity areas that we are interested in, and try to evaluate all the deals that come in, establish those relationships, and generate the deal flow and evaluate all the opportunities and see which ones fit in the criteria that we are talking about. And once we identify a particular investment opportunity that meets our criteria and meets our targeted returns profiles, then we present those investment opportunities to all of our investors. Typically, we send out emails and the executive summary and talking about the details of the deal, the location, the type of the deal, and the structure and typical return profiles. And then we get into all the details of the business plan and whatnot in a webinar setting where we walk through all the aspects of the deal. and have a detailed Q&A session where all the investors who have signed up for the webinar ask their questions, and we try to answer them in the webinar or has a follow-up conversation with them to ensure their questions are answered and they understand all the aspects of the opportunity. Once that's done, this is not a one and done thing, right? I mean, there is going to be a lot of back and forth and a lot of conversations that happen, and we try to keep it transparent and open. We share as much as we can, and whatever we know is shared. We have that dialogue and ensure all the questions that investors have are answered to the best of our abilities. And if that is done and the opportunity is evaluated and you as a limited partner are interested in investing in it, then we share the subscription details. And once you evaluate them and once you finish the paperwork and you wire the funds, and then once all the funds are done, we execute and we close on the deal. Once the deal is closed, that's when the actual execution of the business plan and the sponsorship, and we as sponsors and asset managers, that's when we start executing the business plan based on all the team that we have built, be it property management company, attorneys, accountants, insurance agents, a lot of other construction and development or building crews, all of these guys, lenders for withdrawals of money for capex plans. All of that is done by the asset management and sponsorship team. Once we do that, we periodically share the updates and the progress of the business plan as well as all the financials of how the deal is shaping up. And then as a communicator, we evaluate the performance of the deal on asset, and then we make decisions on the distributions of, be it quarterly or monthly, depending on what was agreed upon as part of the initial business plan. And evaluating the cash flow of the property, we start working with the property management company and do the distributions as well. And then there might be, as the deal progresses, and they will evaluate for a capital event, say a refinance, or if the market is improved and if there is a need, if the opportunity presents itself or the situation is right for us to exit the deal and meet our investors' returns and meet the business plan, the pro forma projection that we have made, we sell the asset, exit the asset, and then the investor capital is returned and all the proceeds are shared as agreed in the initial agreements as well. That's the typical structure of how a syndication deal and a LPGP partnership starts with, and the full cycle of it, right? I mean, if this whole thing is executed, then it's typically referred to as a deal has gone full cycle. And as we say, I mean, it's just rinse and repeat, right? I mean, you find one opportunity after other and build wealth. Now we'll look at a typical syndication structure, right? This is where we're talking about how the entity is going to be structured, what are the classes of investors, what asset managements are, what are the roles, the typical hold periods, and in the screen we also show a typical waterfall written structure as well, right? Let's start with top left in the entity diagram structure that we have shown, right? I mean, typically what happens is there is a single purpose entity that gets created. That entity is the one which actually owns the asset and is the borrower on the loan, right? That entity signs the loan documents and executes and buys the asset. And we as limited partners and general partners, all of us have shares in the entity, right? I mean, that's how the deal is structured typically. And I'm showing only Class A and Class B shares. There could be multiple levels of shares also, right? I mean, off late, because of the sizes of the deals and the complexity of the dollar capital raises and the structures involved and the partnerships involved, I've seen classes of A, B, C kind of shares where there are multiple classes of limited partner structures that come in, and then there are general partners also, right? So for simplicity's sake, I'm talking about Class A shares being limited partners or passive investor shares, and then Class B being the general partners or the sponsor shares. And there is also something called an asset manager LLC or an entity. This is an entity that is created only for acting as a manager for the actual asset entity, right? I mean, there is an entity that buys and borrows money and buys an asset, and we as sponsors form an asset manager entity, and then we manage the asset. That's why the decisions are made and things like that. And in the manager LLC, all the sponsors or the key operators are part of the deal. They are responsible for making the decisions with regards to the asset entity. That's why this is, and only the asset management fees flow through this asset manager entity. And if you see on the bottom left, we'll talk about what the typical hold periods are and typical written structures. So typically when these syndications are structured, right, the hold period is from a 3 to 5 year period. And every sponsor would say, I mean, these are very illiquid assets. So when you are investing, we advise you to ensure that the money that you are investing in, you're not expecting, or you don't need that money in the next 1 year or in the immediate short term, right? I mean, like say you have a kid that you're planning to put to college in a year from now, and you need this money for that. Even though we as sponsors would love to have you invest in a deal, in the right frame of mind, I would advise you not to do that, because once you invest in this, there is no liquidity, and the expectation is this money is locked in for 5 years or the whole period, right? I mean, that's why we advise all of our limited partners to invest money that they don't need in the immediate short term, right? So that's one thing. And typically the whole structures are from 3 to 5 years. I have seen new developments and land development deals and land entity structures and syndications to be on the shorter side, where they have 2 years or 3 years. And value adds I've seen typically structured for 3 to 5 year periods. Even though most of the value adds so far that I've been invested as an LP have been on 5 year holds, I haven't seen anything held for that long, because they execute on the business plan and the market has been so good. They're able to meet their pro forma projections of year 5 in year 2 or year 3, and they exit because the business plan is met. But typically, all the sponsorships, they say that in their webinar or in their documentation what the hold period should look like. So please plan for a 3 to 5 year holds. And typical investor returns are going to be from 70 to 100% overall returns, and that's typical. I mean, that's an assumption based on multiple projections into the pro forma projections and various other assumptions in terms of how the market is going to perform and things like that, right? So please evaluate those pro forma projections and all that the sponsors share before investing your money in it. And we'll talk about the actual sample written structures in the bottom right. Here I've presented a typical waterfall structure with multiple hurdles in it. This is not common. I mean, 5 or 6 years ago when I started investing in LPs, investing in the syndications as an LP, it was a lot more simplified. I've seen straight splits where it's been 1% of split and that's fixed, and then as the deal structures and the sizes of the deals and the competition and all of this have evolved and the complexities have grown, so now I've started seeing more and more waterfall structures. Waterfalls are basically a different way of trying to compensate and aligning the interests of the GPs and LPs in the performance of the assets, right? So in the slide here, we are talking about a 3 hurdle structure here, right? I mean, typically you will see a preferred return for all the LPs. You will see a 6 to 8%, anywhere from a 6 or an 8% preferred return, depending on the size of the deal and the performance of the deal and various other parameters of the deal. In this, we are talking about 8% preferred, right? What that means is the first 8% will go to limited partners only. Let's say if the deal only makes 8%, all the 8% goes to limited partners and sponsors make 0. So this is typically structured this way, so the sponsors or the GPs have an incentive to execute the deal and make the performance of the deal better. That's how it is, right? I mean, so and the next hurdle here is 8 to 15% IRR, right? I mean, most hurdles that you talk about in these syndications, right, they all go by IRR hurdles. So we'll talk about only IRR hurdles here, the internal rate of returns. I've given a link in the slide deck where you can talk about, it details what IRR is, and that's a key metric in terms of returns and how the returns are projected for all of these syndications and projects, right? So 8 to 15% IRR, you will have a 70-30 split, where 70% of the proceeds go to limited partners and the 30% of the proceeds go to general partners, right? This is to say, okay, hey, if you have met a certain performance expectation and we have met a certain hurdle rate, then GPs start to participate in the profits and in the returns that the deal provides, right? And after 15% IRR, sorry, after 15% IRR, the splits will be 50-50. So what this says is, it's in the best interest of the sponsors or general partners to ensure this deal returns more than 15%, because the more it returns more than 15%, the more they get to keep. That's in their, that's how the align, it's to ensure that general partners and their interests and their incentives are aligned in executing the deal better, and the limited partners' interests are also protected. This is how a typical deal structure is. This is not by any means standard. I mean, depending on the size of the deal, the number of parties involved, the complexity of the deal, and the size of the capital raise, and the creativity of the sponsorship group, you can have multiple different structures. Now let's talk a little about what Vedam Capital is. I won't bore you with all the details of this. If you go to www.vedamcapital.com, you'll be able to see the details about what my company does, what we have done so far, our track record, what our interested markets are, and how to contact us. And I've shared them here also. We are predominantly a Houston, Texas-based private investment real estate investment firm. We have started with syndications in multifamily value add space. We have slowly but surely are venturing into multifamily ground up construction, and I've started exploring land development deal, land banking deals as well. We are in the very primitive stages of exploring that, because I want to ensure I understand something before I start offering that to my investors, right? So typically I participate as an LP and learn from the operators who have been in the particular line of business for much longer, learn the nuances of the business, and then for the second and third deals, maybe I'll start participating in the GP side of things, and eventually I'll start doing my own deals in that space also, right? So that's how I've done, and in the multifamily value add space, and that's how I anticipate doing things in the land banking space, also land development and future development spaces also. For now, our focus is predominantly going to be in the residential space, multifamily and residential only. Mixed use developments will do it, but we're trying to limit only to the residential multifamily townhomes and things like that. Our target markets, I'm based out of Houston, so we still are interested in the Texas markets. We'll look for deals in the Texas market and find out Dallas, Houston, and San Antonio, Austin. They form the Texas Triangle. We are interested in these areas by virtue of our presence here and understand the market. But more and more, we have started focusing on Arizona and Colorado, basically the greater Denver and greater Phoenix areas. And I've had some interest and some understanding of the Huntsville, Alabama markets as well. It has come up in multiple charts in terms of the strong markets to invest in, and I have my eyes set on it. We are developing and cultivating those relationships with the local brokers and property management companies and local operators in that space, and hopefully we'll have some deals in that region as well. And next steps, please, my contact details are shared here. You can email me at aditya@vedamcapital.com, or my number is given here. You can reach out to me here. And if you go onto my website, there is a Calendly link where you can schedule some time there. Let's have that conversation, and then hopefully we can work together and get rich and financially free sooner and together. If you have any questions, please reach out to me. My email and my contact details are provided here. I want to leave you with this quote, right? I mean, you don't have to be great at something to start, but you have to start to be great at something. Please start today. I look forward to having a conversation with you all and working towards that. Take care.